Concept of Debit and Credit, Part 1. At the end of this lesson, you will be able to explain the concept of debit and credit, define T account, and explain the rules of debit and credit. Introduction to the concept of debit and credit. Adventure Explorers is a unique travel company specializing in extreme adventure tourism. The company organizes and plans expeditions to various destinations, ensuring all necessary logistics, permits, and safety measures are in place. As the company grew from organizing local expeditions to global adventures, it faced a challenge in transitioning its financial record-keeping system. Adventure Explorers primarily relied on a simple single-entry system, but the complexities arising from their expanding operations necessitated a shift to a double-entry accounting method. The transition to a double-entry system is essential for adventure explorers to enhance financial transparency and ensure accurate record-keeping. However, the complexities posed significant hurdles. How did the company transition from the single-entry system to the double-entry accounting system? How did they manage to record the transactions in the double-entry accounting system? Let us watch this video to learn more about the concept of debit and credit. Concept of debit and credit. To help with this transition, the company sought the expertise of an experienced accountant specializing in financial systems transitions. Meet Sarah, an accountant with years of experience guiding companies through such transitions. Sarah recognized that the first step is to educate the team about the fundamental concepts of double-entry accounting. She starts by explaining the concept of debit and credit. Debit and credit lie at the core of double-entry accounting, which is essential for maintaining precise and balanced financial records. Every transaction involves at least two accounts, that is, debit and credit. Debits, located on the left side of an account, signify an increase in assets or expenses and a decrease in liabilities or equity. Credits, on the right side, indicate the opposite, which is a decrease in assets or expenses and an increase in liabilities or equity. This double-entry system ensures that the fundamental accounting equation, assets is equal to liabilities plus owner's equity, remains in harmony, providing a structured method to record and track financial activities in a business. A T account, named for its resemblance to the letter T, visually represents transactions within specific accounts. It is divided into two sides, the left side represents debits, and the right side represents credits. For instance, in the cash account, left side entries record cash increases like receipts or deposits, while right side entries record cash decreases, such as payments or withdrawals. A T account is a simplified graphical representation used in accounting to depict the transactions and balances of individual accounts. T accounts are a fundamental tool for understanding how transactions affect specific accounts and help maintain the balance in the accounting equation. They provide a visual way to track changes in accounts and are often used in introductory accounting education and manual bookkeeping processes. Rules of debit and credit. All accounts are divided into 5 categories to record the transactions. They are assets, liabilities, capital, expenses or losses, and revenues or gains. 2 fundamental rules are followed to record the changes in these accounts. The first rule is recording changes in assets and expenses or losses. An increase in assets is debited, and a decrease in assets is credited. An increase in expenses or losses is debited, and a decrease in expenses or losses is credited. And the second rule is recording changes in liabilities and capital, revenues or gains. An increase in liabilities is credited, and a decrease in liabilities is debited. An increase in capital is credited, and a decrease in capital is debited. An increase in revenue or gain is credited, and a decrease in revenue or gain is debited. Conclusion? To conclude, The transition from a single-entry system to a double-entry accounting method presents a significant challenge for adventure explorers due to the complexity and diversity of their financial transactions. Understanding the principles of debit and credit, coupled with implementing T-account representations, is crucial for successfully adopting the double-entry system. This transformation is vital for adventure explorers to gain comprehensive financial insights, facilitating informed decision-making and ensuring the seamless expansion of their adventurous travel operations across the globe. Summary. Now, let's summarize the important points discussed in this lesson. The double-entry system of accounting relies on the concept of debit and credit. The debit side, that is, the left side of the T account, signifies increases in assets or expenses and decreases in liabilities or equity. The credit or right side of the T account indicates the opposite of the debit side. T accounts visually represent transactions with debits on the left and credits on the right, aiding in understanding account impacts and maintaining accurate financial records. Assets or expenses increase with debits and decrease with credits. Liabilities or capital or revenues increase with credits and decrease with debits. And these principles maintain financial equilibrium, adhering to the fundamental accounting equation, assets is equal to liabilities plus owner's equity, which is crucial for accurate and transparent record keeping in businesses.